Hello and welcome to this video. So in this particular video, I'm going to be going over GDP and how it affects all of the things in the economy. So this is the most renowned economic indicator that determines a lot of the trades and how they're conducted. So to just begin with, I'm just going to go over the definition of gross domestic product. So in this video, we're going to be exploring the gross domestic product. We're also going to go into the differences in the different GDPs, and we're also going to look at the GDP price parity, and we're finally going to look at how the different countries in the world all have GDPs based on different things, but we're going to put a lot of emphasis on GDP based on natural resources. All right, so let's get started. So the gross domestic product is a monetary measure of the market value of all the final goods and services produced in a specific time period. So this is all that you really need to know about the GDP and what it is. GDP nominal per capita does not, however, reflect differences in the cost of living and inflation rates of the countries. Therefore, using a basis of GDP per capita at PPP, purchasing power parity, is arguably more useful when comparing living standards between nations, while nominal GDP is more useful comparing national economies on the international markets. So there are a couple of terms. So first of all, GDP, when we just say GDP in general, what we mean is nominal, which is the price, right, with the inflation rates of the countries. All right. So when we remove the inflation rates, what we have is a real GDP. All right. And then GDP, our GDP, which is real GDP, only has the removed inflation rates, but it does not highlight the removal of the different costs of living in different countries. So that's where we end up using the PPP. So the PPP is purchasing power parity. All right. So this is another term, GDP per capita. So when we just say per capita, capita is a word that just means per head. Capita, capital, per head, per cap. So GDP per each person. So this is when they take the nominal GDP or real GDP, whatever measure you're looking for. So you can look for GDP, nominal GDP per capita, or real GDP per capita. So you take the total population and you divide it by the market value of all the services produced. So this will allocate a certain amount to each individual in a society. So if you don't really understand it just now, just hold on, because I'm going to re-explain this, because this is very important in understanding financial markets and global macro trading. So the OECD defines GDP as an aggregate measure of production equal to the sum of the gross values added to all resident and institutional units engaged in production and services, plus any taxes and minus any subsidies on products not included in the value of their outputs. An IMF publication states that GDP measures the monetary value of final goods and services. All right, so GDP measures the monetary value of final goods and services that are bought by the final user, produced in a country in a given period of time, say a quarter, 3 months, or a year. So this is all you really need to know. Like you could read a lot of other stuff that goes in depth and breaks it all down, but to be honest, having this understanding that when you hear GDP, what it's referring to is the value of the production within a country in a certain period. So obviously, when there's more value, more production, there's more growth. Okay, so it's always good to have a high growth in GDP. So whenever there is a negative growth, it's a bad thing. And if you have 2 quarters or 6 months, half a year of negative growth, you're in a recession. And the more it prolongs, the worse the recession is until it gets into a depression. And negative growth or lack of GDP could lead to so many other problems. Some countries like shut down because of this. So total GDP can also be broken down into the contribution of each industry or sector in the economy. The ratio of GDP to the total population of the region is the per capita GDP. Per capita, again, this is individuals in a place. So the ratio of GDP, okay, the production at the rate of population shows you the per capita. So it's also important to understand that when a country has a per capita GDP that's high, it does not mean that everyone in the population has the same amount of money. That's now determined by certain other measures that track the equality, the human developments, but usually the GINI index is used for that purpose. The Gini index is used to measure the distribution of wealth in a society. As we already know, according to the Pareto principle, 80% of all the wealth is in 20% of the hands. So the per capita gives you a hypothetical situation or an ideal situation, but the actuality of it is usually very different, drastically so in some cases. So the ratio of GDP to the total national population of the region is the per capita GDP, and the same is called the mean standard of living. GDP is considered the world's most powerful statistical indicator of national development and progress. So, the world's most powerful statistical indicator. So this video is about the world's most powerful stat. So let that sink in. As we get into this video, you might have to see it again, right? Which I would recommend. But this is about the world's most powerful statistical indicator. So there's a lot of misconceptions that are around it. So that's why I do encourage you, if you feel like this is your calling, get deeper into the subject, and we'll get that done. So I want us to just reiterate what is happening here. I just need to find the tab, and I hope I opened the page that I'm looking for. Okay, I cannot seem to find it. I cannot seem to find the page that I am looking for. So all right, so here we go. Yeah, so this is what I was looking for. Okay, so this is GDP nominal versus GDP PPP. So I just want this to sink in. So this is the same concept put another way. So GDP is the total market value of all goods and services produced in a country in a given period. So basically, this is all you need to know about GDP. All right. So each country reports its data in its own currency, but for purposes of this video, you're going to see it in the American currency. So to compare the data, each country's stats must be converted into a common currency. The two most common methods to convert GDP into a common currency are nominal, right? So nominal has everything including inflation, and PPP, purchasing power parity. So we're gonna look at this in particular in a minute. Okay, so this is now the difference between the nominal, all right, and inflation. And it's not only inflation for this one, it is adjusted for inflation and living standards. Okay, so we're also going to adjust for living standards and inflation with the PPP. So nominal GDP estimates are commonly used to determine the economic performance of a whole country or region and to make international comparisons. It is the original concept of GDP. In nominal method, market exchange rates are used for conversion. So this includes the exchange rates according to the US dollar. It does take into account differences in the cost of living in different countries. So this is a very important aspect, the cost of living. Okay, so fluctuations in the exchange rates in the country's currency may change a country's ranking from one year to the next. So this is important for us as Forex international currency traders who are taking a very professional approach. So this is why you're watching this. And not a lot of people get to see this type of information. And it's important for me to point that out because you might not even know it, but you're now in a very few percentile group of people who are able to do things in a different way. And if you're following me, then I'm pretty sure that this resonates with your style of trading, which should be something that helps you along the way in a huge way. So fluctuations in the exchange rates. This is the goal of us investigating all of this information. So fluctuations of the exchange rate of the country's currency may change a country's ranking from one year to the next, even though they often make little or no difference to the standard of living. Again, the standard of living of its population. So we trade from year to year and we trade price change. All right. And even though the price might be little or none, we have to know if there's an opportunity that's presenting itself in the markets. Okay, so sometimes there's nothing that we can do and all we have to do is chill. So now these are the tools that will start getting you onto the track of a professional trader. I used to watch shows like Billions, right? And then I always used to wonder, like, what do those guys do all day, every day? Because when I began trading, all of the trading videos that were there then and that are still there right now have this information about technical trading, drawing a pattern, support, resistance, and that's great. And once we all have that information, it's no longer an edge. But what we have an edge in is how we are creative thinkers. So it's not about just knowing the support and resistance, which can work very well, because up to this point, that's up to a certain point, that's what I'd always done. But then for my appetite and my investing horizons, I like to look at different things. And I always used to think like, all right, in a movie like The Big Short, how did those guys find those trades? Stuff like that, you know? So those are the things that we're discussing right now. And this is potentially $1 billion information if you use it as such. So yeah, so there is really, and this is the most important stat in the world. So let's just keep that in perspective. All right, moving on. PPP basis arguably more useful when comparing differences in living standards between nations. A haircut in New York. So this is an example of the precision that we're looking for when we're analyzing nations, currencies, and economies. So we'll be looking at things like this, okay? So a haircut in New York is more expensive than in Lima. The price of a taxi ride of the same distance is higher in Paris than in Tunis. And a ticket to a cricket game costs more in London than in Lahore. So this is why we don't only look at the GDP, nominal and real. So this is important. We have to see the real GDP numbers, okay? The nominal GDP numbers. So in addition to that, we also have to look at the PPP numbers, okay? So we're going to look at both and see what we discover in this video. So So the PPP is an exchange rate at which, so it is its own exchange rate. So you see, it's an exchange rate, all right, at which the currency of one country is converted into that of a second country in order to purchase the same volume of goods and services in both countries. So what they do is they use this exchange rate as a constant between the two countries to purchase the same value of goods. This is a basket of goods, so they're gonna use that in order to service this, to buy a basket of goods of the same things in different places. So imagine that in your country, all right, let me finish and then I'll give you some of the advantages and some of the disadvantages, because this is filled with advantages. So let's continue for now. So if a hamburger is selling in London for £2 and in New York for $4, this would imply. So this implication gives us an expectation in exchange rates. So this would imply a PPP exchange rate of £1 to $2 so that there's an equilibrium in price. So triple P exchange rates are relatively stable over time. Drawbacks of PPP is that it is harder to measure. It is harder to measure. That's it, right? It's harder to measure than the nominal. So another aspect about this is, imagine that you want to buy an iPad and you live in Ghana, right? You live in Ghana, you want to buy an iPad, and you live in China, you want to buy an iPad, and you live in America, you want to buy an iPad. So one thing to notice about the PPP is that ideally, if a person in China is getting the iPad at $400, you should be able to convert the same $400 and buy an iPad, right? And the same thing applies in the States. So what the PPP doesn't actually put into account are certain things such as the trade barriers, transportation, and certain other things. So this is why it's a harder thing to measure in absolute terms. But in relative terms, you can use it to a good extent, as we're gonna see very soon. But the point of the PPP is for you to recognize the purchasing power that each currency holder has in different countries. So a lot of people have spoken about how things are more expensive in their country because the living standards in their country is higher. And in that place where the living standards and the prices are high, wages are expected to be higher in relation to places where the purchasing power of a dollar outweighs the purchasing power of the same dollar in another country. So this is why it's very important, but obviously it has some drawbacks. And when we measure this, we're supposed to be able to look at it carefully and to see where the differences are, and this gives us an understanding of certain fluctuations that might be anticipated by the PPP that we as traders are looking for and are trying to take advantage of. So this disadvantage in itself is an opportunity. Okay, so it's an opportunity for you to see certain applications in this. So out of 192 economies, okay, 179 have higher GDP PPP bases and 12 are higher in nominal. For United States, both are identical. Okay, so the US, since the US is being used as the proxy currency in most cases, we see that there's a similarity in the PPP numbers. Okay, so here, let's just wrap this up and then move on to some other stuff. So South Sudan is the highest difference between PPP and nominal GDP calculation. GDP of South Sudan is 5.82 times, the PPP of South Sudan is 5.82 times greater than the nominal GDP. South Sudan is followed by Sudan, 5.7, and Myanmar, 5.3. having a triple P to nominal ratio above 5. Okay, so this is something as a trader you're going to be looking for, the nominal ratios, and you're going to have an average and all of those things. We're not going to get into that in this video. So 5 countries have this ratio between 4 and 5, and 34 economies has higher triple P values by above 3 times. So this is a very volatile thing, and it's up to you to discover why this discrepancy is in South Sudan. Are there certain opportunities in South Sudan that are unnoticed because of this discrepancy in the numbers? Because trading is all about looking for opportunities where everyone is looking but no one is really seeing what's going on. So this is why we're getting into the mechanics of things. 5 countries, right, have this 3-time multiple in their ratio. This value is lowest for Switzerland at 0.79. So Switzerland is one of those countries that when you begin to discover global macro, it's a very fascinating place. And we're going to get into some interesting things about Switzerland in a little bit. So there's a large gap between nominal and PPP based GDP in emerging markets and developing countries. So this is due to the different standards of living, emerging markets and developing countries. However, when we look at Switzerland, we see that the numbers are almost identical. But for advanced countries, differences are much closer. Okay, advanced countries have a closer triple P. Out of 12 economies which have triple P to nominal ratio less than 1, PPP value is less than nominal. 6 are among 11 richest, and 8 are among 21 richest in the economies in nominal basis. So 12 economies have a ratio of less than 1, and 6 are among 11 of the richest countries in the world of these 12, right? 8 are among 21 of the richest economies in nominal basis. So these countries, all right, these 12 economies, which are identified as the richest, right, are showing triple P of less than 1. Okay, so this type of triple P is common in countries which are huge and have a lot of money, and a higher triple P is common in emerging and developing countries. So when we look at emerging markets and developing countries, we're also looking at countries like China. So when we talk about China, we're talking about an emerging market. What makes China so special? And just watch the video on the wealth report. I know it's a little bit long, but you have to watch that video. It's going to give you a big perspective on how to invest for the next 5 years. And yeah, watch it. But countries like China are emerging markets, so there might be a large gap between the PPP and the GDP. And as we've already spoken, the exchange rates, right, are determined by the gaps in the PPP and GDP. So this discrepancy, which is common in emerging markets and not common in rich economies, so-called large markets, okay, developed economies, this relationship is inverse. So when we're looking at the changing global landscape of emerging economies such as China, which are now rivaling these large economies such as the US, we have to put on our investigating hats on, because there might be an investment opportunity. Investment is all about investigating. Okay, so now let's look at the numbers, what they actually look like. Okay, so this is trading economics, okay? And right here we have GDP annual growth rate. This is what we're looking at. You know, there's all of this other stuff. It's a very cool resource if you're a global macro trader, right? Which is an aggregate of what's happening in the world. Okay, so here, GDP annual growth rate. Okay, so what we're looking at right now are the numbers, the percentage of growth in the GDP. Okay, this is whenever it says GDP, it means it's nominal. Okay, and then when it says GDP per capita, all right, no, not per capita, GDP per capita, it means it's nominal GDP for each person. So this is GDP annual growth rate, which is simply okay, so a lot of things are happening in the markets. So yeah, so GDP annual growth rate. Okay. I just kind of lost my bearings a little bit because of that report that just came out. The US is seeing a hard time in the manufacturing sector. But anyway, that's okay. So here we're looking at Europe in particular, and we're seeing that these numbers are representing the yearly growth of percentage in the difference of the GDP nominal of every country, which does not include or does not account for difference in lifestyle and inflation. So this is just the raw digits, which gives us an overview. Okay, so the highest in Europe, the fastest growing. This is what it is. The fastest growing country in Europe is Ireland, which had 6.2, and Serbia, which had the same one. So they were tied. And Serbia and Ireland seem to always grow quickly because these numbers are pretty high, 6%. All right. Then we have Turkey. All right. Turkey has seen some hard times, so it must have fast and big growth because it's coming out of a slump. So this is a high growth number. Okay, so here, just looking at these countries here, just on the first page, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. What we're not seeing is what we should first question. Where are the biggest European countries? Where's the UK? All right, where is Germany? Where is Italy? All right, where are the G20? Why are they not growing so fast? Why are they not growing so quick? I thought they had all the money. So let's try to find them. So Poland, a big-ish country, okay, 3.2% GDP last year, almost 4%, pretty high, pretty good. All right, Lithuania, Denmark, pretty okay, 2.2%, 2.6 previously, okay. Still haven't seen Germany or UK or France. All right, Switzerland. All right, there we go. Netherlands, 1.6. Switzerland, 1.5. Previously, 1% growth in the whole year. That's pretty small. And Ukraine, Belarus, Norway, 1%. Previously, 1.8%. Greece, 1%. Sweden, 0.5. So now it's getting a little bit like we're seeing all of the staple names, the European names like Switzerland, Netherlands, okay, Norway, Finland. All right, Germany, 0.4, previously 0.6, which is really very low because it's less than 1%. Okay, and beyond that, we're looking at March 2020 information in this column. So this is influenced by the lockdown that's currently happening. So we are going to look at the previous year. So Moldova had high growth, but the UK seems to grow like 1%. All right, Austria 1%. These are pretty small, and the EU in aggregate 1.3%. So far it's had a steep drop. The euro area and France, Italy here, Spain there. So we see that these numbers are not so quick. But now we're gonna take a look at the world and look at the GDP of the world. So we're looking at the GDP annual growth rates of the world. So off the bat, we see number one on the list is Ethiopia. All right, this is because of this is the fastest growing economy, but this is for 2018. Okay, so let's look for 2019 because we're in 2020. So since this is a little bit outdated, we're just gonna put this aside, right? But the last number it showed us was that Ethiopia was growing quick. So we're gonna see if it maintains this growth at around 9% for 2019. All right, this is a fast growing economy. So from the updated data, we see that Rwanda seems to be the fastest growing economy in the world. And it's previously had a 10% growth. That is pretty high. Just scrolling down here, I don't see anything else with 10%. So this is pretty impressive. So again, as professional traders, what we're looking for are these opportunities that a lot of people see but don't see. So something like the innovation in Rwanda is something that you can get deeper into and look at what's happening. And when you do realize the fact that in Rwanda they've developed their own smartphone, they're now making their own type of car, and they're developing their own innovation hub, and all of those things. This is contributing to such high growth numbers. So moving, just looking at the face of the GDP annual growth rate, okay, the most important stat in the world. We see that on the face of all of the fastest growing countries in the world, we're not seeing all of the staple names, like where's the US and all of those other countries. Instead, we're seeing Ghana, Cambodia, okay, Tanzania, Mauritania, Laos, Nepal, Ireland. Okay, so keep Ireland in mind because this is a country that is really outperforming because it's growing pretty quick. The economy is pretty stable, and I think there's a lot that can be seen in some of the developments happening there. Could be a potentially great place to invest money after more investigation. However, now I need to put a certain important point, and I have to announce the point because it's really, really important. So as you can see, all of these countries that have high growth are relatively small countries. Like Niger's economy is really small. All right, if I'm not mistaken, their economy is like their GDP, like this 6% growth, okay, is being calculated in terms of I think it's 8 billion gross domestic product. All right, I'll check it in a bit. But this country is very small. So a 6% growth is a large percentage in relation to other countries. But in real terms, it is not positive growth because we're looking at how they're utilizing their resources. So a country could be small, like like Luxembourg, for example. It could be small with a population of 600,000, but based on the utilization of the resources, calculating the GDP per capita, we discovered that Luxembourg would be one of the more successful countries on earth. Okay, and even though their growth might be small, let's see if it's here. All right, Luxembourg is not here, but it will be further down, if not even negative, because of what's happening. But anyway, Kenya is pretty good right now, and it's developing pretty well, and its growth is really high. So it's really about refining certain ideas. Uh, uh, to see Maldives, because Maldives' economy is also very small. I think under 10 billion, but this growth is quick, and the Maldives has a small economy, but then it has a high value economy. So this is a very important thing, that just don't look at the fastest growing and think that, hey, this is where I'm going to put my money. But in a sense, the fastest growing country in the world is in Africa, and it's Rwanda. Okay. And I won't say Ethiopia. Ethiopia is in the top 5 perhaps, but it's Rwanda, which is growing pretty quick, and Bangladesh, okay, and Ghana. All right. And of these countries, Rwanda is upholding a great service economy. Okay. Ghana has a lot of natural resources. It has oil and all of that. So these are things to think about, to look for, to look at. Okay. And then you have all right, so let's just go down, further down. Malawi, pretty high growth. Okay. India, okay. So India is right here. Okay. And this is 2019. This is up to date. Okay, because this is 2020. So this is the next number will come out in 2021 for 2020. Okay, so this is up to date. This is all the info we have on India in terms of GDP annual growth rates. All right, so India is at 4.7%, which is pretty high. So if it maintains this type of growth, there might be a lot of opportunities in India. So what you'd have to do is to go down into the economy and look at where the GDP is actually coming from. So just popping the trunk and seeing what's happening. So you have to look at the employment rates, the unemployment rates, the business sector, and the productive areas and things like that. However, let's just go down. Iceland, pretty high growth. Okay. Egypt, high growth over there. I didn't talk about Egypt, but it's pretty huge, second biggest economy in Africa. Seychelles, pretty high growth, 7.1%. And the Seychelles, an African island, it's a very lucrative investment. Israel, pretty high, 3%. Yeah, it's upper middle growth, but this is pretty impressive. And there's a lot of development in Israel and all of that. Okay, now we see some Poland right here. All right, cool. Costa Rica. So Nigeria, 2%. So Nigeria is the biggest economy in Africa. All right, and as we can see, it's not the fastest growing economy in Africa. The fastest growing economy in Africa would be something like Ethiopia or Rwanda. Okay, so we'll see how fast Ethiopia grew in 2019, because right now we don't have that data, but Rwanda seems to have been the fastest growing economy, and countries like Ghana are growing faster than Nigeria is growing faster. However, Nigeria is bigger than those countries. So if you're growing if you have $100 billion, right, and then you keep on growing $100 billion at 1% every year, you're pretty good. You'll probably be rich forever. But then if you have $10 and you're growing $10 at 20% a year, right? You're growing $10 at 20% a year. If you're able to maintain a growth rate of 20% perpetually, you're gonna be richer than the man with 100 billion who's just growing it at 1%. So what usually happens is that these countries, first of all, have a very high growth rate, but at a certain point they slow down. Okay, so this is what we're seeing. So these economies right here that we're looking at, these are a bit slow but kind of fast, so they're probably slowing down a little bit. Okay, so they might have been 10% growth once upon a time, but maintaining 10% growth is not practical. So there's So there's a ratio at which these countries are supposed to keep on growing. But good growth rate or an average growth rate for these countries is something that we see in places like Australia, all right? Somewhere around 2%. Okay, around 2%. So this is where we see our staple countries, the Denmarks, okay? Portugal is here. Congo should be growing faster than 2% because there's a lot that can happen in Congo. You can do a lot. So if Congo is growing at 2%, right? How long will it take for it to catch up with Dubai, you know? So it has to grow quicker, okay? Morocco. Morocco is a pretty huge economy already. Pretty huge economy. So 2.1% might be fair for what it already is, what it represents. Russia, 1.5, Mozambique, 2%, Sri Lanka, New Zealand, okay, New Zealand, we have it here, about 2%, Botswana, 1.6%. So Botswana, not the fastest growing, okay, but then we will have to look at the region, what they're doing, but it seems like they could be growing a lot more. It could be, but we'll have to see what the factors are. Namibia had a negative GDP for the year. This is bad. And coming out of the slump, they had a 1.6, which is positive. All right, we'll just leave it at that. It's positive. Thailand, all right. And yeah, Thailand's economy is pretty huge. I think it's around 400 billion, if I'm not mistaken. Around about the Emirates, I guess. Canada 1.5, Switzerland 1%. Okay, so these are the huge economies. They just grow like at 1%. And Swaziland, South Korea 1%, 2%. Norway 1%, 1.8%. All right, Zambia 1%. This is bad, but we'll see. We have to know why this growth was. And right now, what we're just doing is we're looking at a very short time, right? We're just looking at 2 data sets for 2 years. So don't take everything at this depth of data. So you have to dig deeper, actually get an average estimate of what the GDP growth is. Because for a country like China, at some point their average growth was 8%. So if China ever had a GDP reading of 7%, they'd be like, oh, something wrong is going on in China. It's now slowing down. Okay, so right now China's average growth is 6%. It used to be 8%. All right, so it is now what they termed the new normal. All right, so we're still scrolling down, and here we have Germany, which is the biggest economy in Europe, in the EU, which grows at less than a percentage. Okay, then now we have the biggest economy in the world, which grew 0.3% last year. No growth, kinda like 2.3% the previous year, which is pretty okay. But we find it all the way down here. So it was actually one of the slowest growing economies. It wasn't zero like Jamaica here, all right? But it was near zero, all right? So one of the slowest growing economies, America, all right? And where do we find China? Where do we find China? Have I passed China? Because I don't remember mentioning China. Because I should mention China. Because everything is China, you know? Is it all the way up here? Could China be all the way up here? Oh no, sorry. Excuse me. China is, right now, it's probably is in the negative territory. Alright? So, alright. So here we go. China. Minus 6.8. So this is for March 2020. So this is like really up-to-date information. So it's showing the impact of the pandemic, all right? And oh yeah, and there's this star player here. So yeah, so high growth usually 4%, which is pretty high. All right, previously 4%, pretty high growth, could be higher because in Zimbabwe the GDP is minus 6.5, but at some point it was 12% after getting out of 2008. That slump, the GDP growth was double digits. Okay, so could be much higher. And France negative, but slow growth. Italy very slow growth. So countries like Venezuela, for years there's been negative growth. And you should check out the video on the oil money, African oil, stuff like that, OPEC, and it's about Venezuela, which I think is a very interesting issue. Hong Kong, because of the riots, negative GDP and things like that. Macau, negative GDP. This is 2019. Okay, so all of these things have to be qualified, all right, before you actually invest your money, all right. So this is showing the different readings of GDP, and you saw like America is at the lower spectrum along with the UK, all right, and Mexico, because of these renegotiations that they have to make and all of the differences that are in the economy. But there's so many things to consider, okay. And South Africa it's been negative, and this is due to the power cuts, okay, less production, 0.5, but it's not a deep drop, but it's a drop, which is bad because it might continue, and it's not the only one. So this is something to consider. Philippines growing pretty quickly, but right now because of what's happening in the world it's not. So this is another one to watch, you know. So all right, let's move on to the next. So now this is just showing the actual percentage value in the GDPs. Okay, still on trading economics, seeing GDP, and as I mentioned, if you just see GDP, it means it's nominal, means there's inflation in it and it's not being adjusted for living standards. All right, important. So the highest GDP in the world is the United States at 21.2 trillion. So this is in billions, all right. So this is 21,200, and then we add the zeros for the billions, we get to 21 trillion. So this is followed by the EU at 19 trillion and China at 14 trillion. And we see that all of these countries are growing, and all of those percentages we're looking at are calculating these amounts. So when we're looking at the GDP growth of America, all right, we're looking at the United States growth, even though it's 0.3, okay, it's 0.3, but this 0.3 growth is positive, because if they can maintain growth on a absolute basis, just maintaining growth, even if they're maintaining the growth of this 21.2 trillion, it would be a huge economy. But when we look at how the growth of America is so slow, right? It's so slow right now. But the growth of places like China is so fast. Because imagine we're considering 0.3, right? And the previous one was 2.3, which is fair, okay? 2.3 is fair. But then we're considering this we're comparing it to China. This is why China is a problem, which only has 14 trillion, right? But it's compounding that at 6%, you see, and on average, and that's normal. So if it drops below 6%, maybe at 4% or something, maybe 5%, this would be a new normal for them, which will still be faster growth than the US. So it would take them years, but they would reach 20 something trillion at a fast pace. So you can look at the average percentage, which I'm not going to do right now. We can do that in a special video so that we really get into the numbers, like deep into them. But right now, I'm just going on the surface so that I can give you an idea of the landscape of the GDP, the most important stat in the world. Anyhow, the euro area, which is different from the European Union, all right, has 14 trillion. But just consider the European Union for now. Japan, okay, 5 trillion, Germany 4 trillion, UK close to 3, France close to 3, India. So India close to 3 trillion, and also consider the rate of growth in India, all right? So China and India, Asia. This is a fast growing economy, a fast growing zone, right? Huge populations as well, and there's a lot of money. Like if an economy is above 1 trillion, it's huge. If it's above 100 billion, it's huge. All right. So watch this space. Italy 2 trillion, Brazil 2 trillion, Russia 1.7. So Russian growth, I don't remember what it looked like. What did it look like? Or I'm just gonna go here because I don't know if it's high or low, because it might be for the last part. All right, so the fastest in Ireland is 6.2. The fastest in Europe is Ireland with 6.2. Oh yeah, Monaco. So, but then Monaco has a negative reading previously, but Monaco is an interesting place. Okay, I'll put it that way. Russia 1.5, which is which is not so impressive actually, but it's a huge economy, so that's how it is. So what I was trying to explain is that it's not exactly about about how fast a country is growing. It's not about that, but in a way it is. So just look at those factors and consider them. See what they mean in the global landscape. This is what I'm doing. This is why I'm doing this. So you're just actually just on this. Like I would naturally just go. I would naturally just be looking at this, but now I'm doing this while I'm just talking to myself out loud, and hopefully you resonate with me. So I don't know. I could do this for day. Like this is what I do every day. So this is just. Yeah, this is just another trading day for me. Okay, this is what I look for, and I'll be looking at this, trying to find these relationships with or without you. So I hope it's better that we're doing this together, because for me, I'm having more fun. Even though I'm doing it with my imaginary friend. So South Korea 1.6. All right, South Korea is an interesting case. And it's interesting because South Korea is one of those countries where the nightmare has come true, where the corporate entity accounts for most of the GDP, the production in the country, which is the Sonys and all of that. All of their corporate entities are where their GDP is coming from. So they have so much power. So when you're looking at that economy, you should keep that in mind. And it's important to also, if you're gonna trade South Korea, anything to do with it, if you're trading the won, then you have to also look at their stocks, their services, their manufacturing and things like that. But yeah. Indonesia, see, it's a huge economy, like 1 trillion. Mexico is also huge, 1.2 trillion. I always used to think that Mexico was not so big, but then it's pretty big. It's a huge economy, 1.2 trillion. That's no small matter, because of what they can do with that money. So it's one of those things to also realize. The peso is an opportunity. Of a similar weighting to the Aussie, but not exactly. The Indonesian rupiah, I'll get back to you on this one. Netherlands, Saudi Arabia, Switzerland, somewhere around here, 715 billion, which is a very big economy. Poland, 600 billion. Sweden, 500 billion. Thailand, 520 billion. It's pretty big, right? I thought Thailand was somewhere around 300 billion, but 500 billion is big. Austria is pretty big as well. 460 billion. Argentina is pretty big. All right, Argentina is pretty big. Norway 450, and all right, we could go down the whole list, but we'll stop here ish. All right, let's see. Maybe I'll see something I like. Yeah, because it's not about. All right, Nigeria. This is the biggest economy in Africa, 410 billion, which is pretty big. And then Singapore, pretty impressive one. And then Ireland is over here. And remember, Ireland is something to watch because of what we saw, so much growth and things like that. So I'm actually gonna take a deeper look into that one. However, whenever we're doing this whole exercise, South Africa here 350, Egypt here 280. This is the third biggest economy in Africa. All right, and then we have New Zealand, which is pretty cool, 200 billion, and Morocco, one of the biggest economies in Africa. Angola. All right, I'm just gonna look at Africa in particular, because you know that's where I'm from. Blah. So Nigeria, South Africa, Egypt, that's the top three. And then Algeria, all right, oil money. Morocco, 120 billion. So 100 billion, Angola, which is pretty cool because it means that there's a lot of money in that economy. Ethiopia, one of the fastest growing, 94 billion. So what we're looking at is the fastest growth of any other country, and what they're growing is a product of 94 billion. So this is something that you should consider because it's only a matter of time until they reach 100 billion. And that $6 billion difference, you know, some people are gonna have a huge share of that $600 billion difference. All right, so of that $6 billion difference. So if you want a percentage of $6 billion, you have to invest in the fastest growing economy. After identifying it, Tanzania over here, one of the fastest growing economies, 59 billion, which is okay. But all of these are now a bit on the smaller sides. But Botswana, it's an interesting one to watch. Namibia, pretty small but interesting to watch. And the smallest economy is Sao Tome Principe, which is okay, 400.42 billion. And then South Sudan, wow, this is not good. So South Sudan was like called a failed state, all right, because of this stuff, because they're losing so much money. All right, they used to have 3 billion, but now they only have 1 billion. They used to have 1 billion, so what are they gonna have next? So when we look at these countries like the Seychelles, it's pretty low, $1.6 billion economy, but you have to look at the population. It's also important. All right, just like Djibouti, look at the population, 2 billion, but look at the population, and then you get it. So what we're trading is not actually just trading. All right, I want to see Niger. I think I mentioned it. Yeah, less than 10 billion, 9.5. Rwanda, one of the fastest growing, okay, 9.8 billion. But is it to say that from the time when it's 9.8 until the time is 20 billion, if it keeps on growing at 10%, for 10 years, you're like at 20 billion, are you gonna want to have a percentage that gives you $1 billion in 10 years? So this is what we're doing as global micro investors. We're looking at like what people like George Soros look for in terms of trading. Because, all right, I know that George Soros traded this economy's currency, the Thai baht. He made a lot of money trading the Thai baht, which is a $520 billion economy. And through this, he was able to make billions, all right? So if you want to make millions, hundreds of thousands of dollars, you're supposed to be able to see what's up and look at the different countries in the world. All right. So let's move on. Now we're looking at GDP per capita. All right. GDP per capita. So Luxembourg has the highest GDP per capita. So remember, the GDP per capita measures the GDP divided or at a ratio of all of the people in the country, of the population. And globally, the GDP per capita of Luxembourg, which has a population of less than 1,600,000 people live there. So if all of the money in the country was divided equally among the citizens, each person would have 107 million. All right, this is per capita. The next one, highest ranking country, is Norway. All right, so now, given this information, what we're gonna look for is the fact that, all right, Norway is on this list, right? So what makes it so special? Is there some hidden value in Norway that we don't know about? Okay, so we just looking at the GDP, right, growth rate, we can just go to Europe and see if Norway is growing at all, right? Because it might have a high GDP per capita while it's in a recession for the last 2 years, right? So we're gonna have to look as far back as possible for a country like Norway. All right, so it's been growing, positive numbers, all right, but not the fastest growing in Europe. So that's good, that's good. So we do this not only for Norway, but we do this for Switzerland, which has the third highest GDP per capita in the world, which means that the Swiss are rich, the Norwegians are rich. In other words, the Luxembourgs are the richest people, all right, followed by the Irish. So Ireland, which is what I was saying, you have to keep an eye on, has very high growth. And do I remember how many billions their economy is worth? Let's check that out. I forgot. Like, so this is what I just do, man, or woman, or child. I don't know. Yeah. So this is what I do, you know, just go over the data, go over it again, you know, check it, recheck it, make sure I understand in a way that suits my own way of understanding things, right? Because, you know, this is what it's about. I think I just saw it, but I can't see it. All right, cool. So we're looking at an economy of around 381 billion, which is pretty substantial. So, and the people there have, like, if each person was given the money, everyone would have close to 80 grand, same as Switzerland. All right. So how do these two compare? So there's so many ways we can look at this dynamic. All right. Qatar. Interesting. So why would anyone think of investing in Qatar? Because you have to find out, like, why the people are so rich. All right. Oil. Then you're like, okay, fine. How does oil impact their community? Denmark. Okay, so the Danes are rich. All right. So they have a high GDP per capita, which means that their production, according to their own population, has a proportion of this much. So it doesn't mean that everyone in Denmark has 62 grand in their bank account sponsored by the government. In fact, the opposite. It often means that a lot of people have most of the money, but not in all the cases. So when you look at certain economies, such as Norway, you discover that there's an actual program where the government invested their money. So the Norwegians all have a trust fund. They're all trust fund people. So this is why certain things are free. Like, they can go to college and uni for free because the government invests in the profits they get from trading their oil and their natural resources, and it goes back to the people. And when you go into the video of OPEC and the crude oil economy, you discover certain things like Norway is one of the biggest producers of oil, but they actually don't have a lot of oil. So in the terms of the per capita, I want us to just find China and India on the list because they stood out in terms of having huge economies and having relatively large growth percentiles. So Singapore, all right. Singapore is high on the list. Sweden is high on the list. Australia is high on the list. Netherlands. Oh wow! And now we find America way down the list. But in all other charts, it is the biggest. Like it's number one. But then here it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It's not even in the top 10. Australians, the Swiss and Norwegians, the Singaporeans all have higher GDP per capita numbers than the US. All of them higher than Canada. All right, Japan is down here. So all of these countries, they're doing well, but then all of this is information that impacts their economies. All right, so Italy is down here. Have we seen China yet? No. Croatia, Turkey down here. Malaysia. Oh, Russia is down here. Down here. Whoa, Russia has a very low triple P. So does Brazil. So does Mexico. So does Argentina. Alright. So Botswana has a higher triple P ratio than China. No, sorry, higher GDP per capita than China. Although Botswana does have a small population, but this is what I was mentioning. That the alright. So we're gonna come back here and find. Alright. So Botswana. This is it, right? So what is this? GDP numbers in Europe. Alright. No. Alright. Yes. It's okay. I just want to find Botswana. So Botswana has like a $17 billion economy, all right? And according to their population, all right, their population says that their people are doing way better than the people in China. And China has a $15 trillion economy, but a $1.3 billion population. So their GDP per capita is low in comparison to Botswana, right? So how do you reconcile that? The Maldives, very small economy, but their GDP per capita is higher than China. So if China is going to compete, it has to really outrank a lot of these countries in terms of per capita GDP, but that's not all. We're going to go into the next level and break the inception. South Africa is way low over here. Now we have to find India. And then we're done. Then we'll move on. Thailand, Namibia, Jamaica, Swaziland, that's not Switzerland. Morocco, whoa. And Morocco has one of the biggest economies in Africa. Should not be this low. So does Angola. Alright. The Philippines, one of the fastest growing. Okay, $1 trillion economy. Oh, Nigeria, this is the biggest economy, all right, in terms of GDP, but not in terms of GDP per capita. All right, we're just going to look at Africa in isolation in a bit because it's always important to look at that. All right, this is Zimbabwe. Wait, why? I think I've missed India. All right, I'll just check it again. All right, Rwanda. All right, this is where we are at. Rwanda. All right. So we mentioned Rwanda a little bit before, but we'll look at Africa in isolation. I'm just trying to find India. Let's see what the number is looking like. All right, so Singapore, Qatar, Macau, Japan. So this is, so in real terms, when you're actually looking at the value of the economy and all of that, in real terms, you're supposed to see what the per capita is saying. and this gives you a better picture of what's really important in that economy. All right, for some reason, all right, I couldn't see this. So it's 22,104. So in the world, how low is that? Okay, so the highest, oh, that's pretty low. That is pretty low because the highest is like around 107,000, 110,000, right, per capita. That's Luxembourg, and India is around 2,000. However, it's like one of the highest GDPs, but one of the lowest GDP per capita in terms of comparing the countries with the similar economic value. All right, I just went to the somewhere around 2,000, somewhere here. All right, great. So around Nigeria, oh, I didn't see it. I don't know. It's just so many things that are on the screen, you know, so many numbers. They all look the same at some point. But anyway, so India is doing better than. All right, so India is doing worse than all of these countries, whereby it has a larger GDP to most of these countries. All of them, 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 all of these countries. So India should not be this low on this list, all right, based on its actual GDP value. All right, so is this all clear? Great, let's move on. All right, so now we're just gonna look at GDP per capita, PPP. All right, let's see. Yeah, so GDP per capita in terms of price parity. All right, so this is still looking at each individual, but now we're gonna look at it based on living conditions. Oh wait, before we go there, I just want to check out Africa exclusively in terms of GDP per capita. All right, per capita. So the highest GDP per capita in Africa is the Seychelles. The second one is Equatorial Guinea, and the Seychelles has 14,000, which is pretty high, right? And Equatorial Guinea 10,000, Mauritius 10,000, right? And then Botswana, one of the highest ranking, but one of the smallest economies. All right, very important. Libya 7,529, which is pretty good because of their economy. All right, South Africa, one of the highest. All right, but then it was ranking. But in terms, this is just in Africa exclusively. All right, and the lowest would be. All right. Oh wait. Rwanda, not high. All right, should be higher because it's one of the fastest growing. All right, Ethiopia should be higher because it's one of the most populous countries and it's one of the fastest growing. But the least one is Burundi, you know, followed by places like Niger. But where is South Sudan? Where is South Sudan? Because South Sudan should. South Sudan has an economy of 1 billion, which is not okay. All right. So anyway, this is from the Seychelles to so the top 5: Seychelles, Equatorial Guinea, Mauritius, Gabon, and Botswana. All right. So these are countries whereby when you see these figures, these countries stand out in a certain way among all the other countries in Africa. Although Nigeria, where's Nigeria? All the way down here is the biggest economy in terms of GDP. In terms of GDP per capita, the Republic of Congo is doing better than Nigeria. Namibia is doing better than Nigeria in terms of per capita. So, so we can go into that aspect later, but now want to look at per capita in terms of price parity. So again, this measures the value, the purchasing power of this money in these different countries. So again, Qatar, Macau, Luxembourg. So Luxembourg was the highest, but now it's not because of the purchasing power, which means that in real terms, that money would be 9,300. But in Qatar, let's go to Qatar and let's go to the world one, right? So this is Luxembourg, Norway, Switzerland. But in terms of purchasing power, it's Qatar, Macau, and Luxembourg. So we have a very dramatic shift, but not. It's at least Luxembourg is still in the top three, but now we have Singapore, Brunei, Ireland. So where's Switzerland? All the way down here. All right. Why? Because things in Switzerland are expensive. So even though you have what was it, 80,000 in GDP in Switzerland, even though you have that in cold hard cash, in practical terms, you're gonna be paying more for your rent than you would in Qatar. All right, you're gonna be paying more for your rent than you would in another place. So this is why it's important to look at the different standards of living. In the same way, a person would make a consideration of how much it would cost to live in New York as opposed to how much it would cost to live in Alabama. So the lifestyles will be different, the costs will be different. So the pays should be different, and how much is a lot is different, how much is a little is different. So in a place that has cheap goods, having a salary of $1,000 could be enough because the rent is 100 and food is 300 and the rest, the 600, is for investments or whatever. 1,000 is great, but in a place where the rent is 800 and the food is 500, 1,000 is poverty. So this is per capita and the PPP. So now we're looking at these countries, and to me, seeing this dynamic in the triple P is how we should look as traders. However, as you've already seen, we look at all aspects. All right, so we should look at Singapore as a tradable country and look at how big these economies are. Singapore around 300 billion, I guess. Ireland, that one we're watching, pretty high, right? So pretty good. Norway still high, Switzerland lower but high, Hong Kong, US even lower now, Netherlands, Denmark, Sweden. All right, then the list goes on, but let's look exclusively at Africa. Let's look exclusively at this continent. So I just want to compare it. So the top three in terms of per capita: Seychelles, Equatorial Guinea, and Mauritius. But now what we're seeing is that it's Seychelles, Mauritius, and Equatorial Guinea. All right, so this is now in terms of triple P. All right, Seychelles, Mauritius, and Equatorial Guinea. All right, I think I need to close some of these tabs because my screen is acting a fool. All right, I hope I'm not going to need them anymore. And if I do, forgive me. So Seychelles, Equatorial Guinea, and then Botswana is in the top 5. Seychelles, Equatorial Guinea, Libya, Botswana is in the top 5. So this is pretty much consistent, and this is the triple P and the actual thing. South Africa is not the biggest in terms of GDP per capita in terms of real terms. So that money is a lot in Seychelles, so Botswana. So it's pretty much consistent. Egypt, pretty low. But the number is good, about 11,000, right, for every person. Nigeria is pretty low, and Mauritania being the lowest. All right. So this is exhausting in terms of thinking about it, doing it, and acting upon it. But it's very important. Rwanda down here. All right. Now I want us to go to the last bit of this. Now we're gonna look at GDP in other terms. Oh snap! I hope I'm not gonna need all those pages, but yeah, I just closed more tabs. But now, so there's no looking back. So I'm just gonna make this quick, fast now, so that I can get your concentration span while you're still able to concentrate, and me too. So the last bit, this just take a segue. We're just looking at gold reserves for no apparent reason. So the gold reserves in the world, the country with the most reserves is the United States. All right, followed by Germany, Italy, France, Russia, and China. All right, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Right. So these are the countries with the most gold. They keep that. All right. Now, list of countries by GDP sector composition. So in this article, Wikipedia, this is what it's about. So it's listing countries in terms of agriculture, industry, and service. And I'm gonna save you the time and make time to read this if you're not brushed up on the differences in the different sectors. So I'm just going to go straight to natural resources, because as I said in the beginning of the video, this is somewhat the focus of what we're doing. So all of that is a background. So this goes into my hypothesis of what could be going on in the next couple of years in terms of trading, and go on and watch that video about what's it about? It's about the wealth report. Excuse me. Yeah, my mind's in so many different places right now. So watch the video about the wealth report. Okay. So here we're now looking at the GDP of natural resources, and I guess we'll come back for more in terms of, there's more information that I wanted to share, but I really don't want to make this too long, because it's just not good. Anyhow, so now we're going to look at the country, right, which would be here, the total resources as a percentage of the GDP. All right, now the resources we're going to be looking at is oil, natural gas, coal, minerals, and the forest. So off the bat, let's just look at the countries which have a huge percentage of their money in the GDP coming from natural resources. All right, so this is 0, right? 0% for these countries, but we're gonna flip it and we look at, this is the highest. So Iraq depends on its GDP, its gross domestic product is 78%, almost 80% weighted on their extraction of resources, minerals and stuff like that, followed by Congo, Saudi Arabia. And as we've already seen, Saudi Arabia, one of the bigger economies and relative growth, and they are heavily dependent on their natural resources, which they use within their country. Mauritania, Kuwait, part of the OPEC, Gabon, Angola. All right, one of the bigger economies in Africa, Mongolia, Oman, Uzbekistan, Brunei, Chad, Kazakhstan, Trinidad, Tobago, and all of these. So this is the list, okay? This is the list, and I'm gonna scroll down. This is Nigeria over here. 15% comes from their oil and other resources. Norway, 13%, and as I've already mentioned, Norway has used their oil reserves, or their GDP, which is 13% weighted on their sovereign wealth fund, which is pretty amazing. So through that, they're able to fund so many things, and it's an amazing thing because they found this in the Norwegian Sea. Russia is also heavily dependent on its exports and production. So it's South Africa, 10%, Australia. But as usual, I'm looking, all right, this is China, 9%, all right, Zimbabwe, 6%, all right, and I have to find America. All right, this is way easier when you're looking at the flags. So 1.7% is their GDP dependent on natural resources. So here, this point, the point that I'm trying to bring out, like we've already gone through certain other ideas that we can add on, subtract, and multiply in order to create trading ideas. But now I just want us to look at natural resources. So the way that I see it is that in the next coming years, there's going to be more demand on natural resources and a greater demand on cleaner energy. So there's going to be a shift in those prices because of supply and demand. But the countries that have these natural resources and are very dependent on their growth on these countries are supposed to be very valuable because of what they have. Okay, their total natural resources. So looking at oil as a dilapidating resource because of climate change and all of that, coal, oil, and all of those things, it's not going to be very lucrative as it might be. So what I'm going to look at is this section here, which is the minerals. So now it's going to show me all of the countries that have trade that is dependent on minerals. Okay, so it's just looking at the minerals. So Mauritania would be the highest. All right, I closed that tab and I wanted to look at its PPP per capita. And then Papua New Guinea, all right, has a lot of minerals. So when we're looking at minerals, we're looking at gold, copper, platinum, aluminium, which supports industry and which is likely to keep on growing. All right, and places like Congo, already their trade is 35% natural and 22% mineral. Okay, so all of these countries must be growing because of this demand. And here we have Australia, 10% dependent on trade, 7.2 on minerals. So Australia is actually one of the highest exporters of gold, and so is Canada, because they refine gold. So they're known as the biggest gold producers in the world. So in the case that minerals are appreciating in value, what is going to happen to their currencies? Mauritania, Zambia. Okay, Zambia, heavily dependent on copper. All right, 25% of all of their exports are dependent on minerals. So when we look at this, we see that some of the countries are not weighted in terms of GDP for the growth in their minerals. So in a world where we have a stable currency, do you know what would be happening? We would have a country like Libya. Where is Libya? I think I missed it again. All right, basically what would happen in a world where we had a very stable economy, stable currency and everything? We would have commodities which are holding the value of money, and through this would have a stable currency. So a country like Ghana, right, which depends 14% on natural resource, natural GDP, would mean that it should in turn be allocated a higher share of global wealth because of its natural resources as a percentage of GDP. All right, so Congo is among the highest in Africa, but I believe that this is actually less than it should be, 35%, because of the growth rate we saw, because of the technology they're using, all of these other things that we can actually consider. So if you're a person who is trading, what you have to do in terms of a country like the DRC is, if you wanted to make a great trade, those trades that you see on TV, you'd be a person who is watching the DRC, and if by chance something significant that changes the fundamentals in the country, such as it adopting a new law that makes it able to change their oil into contract, like so many things can happen. But if you're watching it and you see the fundamental shift, that should give a, a realistic and sustainable but high reading of growth. You would look at that and you'd actually trade that. All right. So the same thing can be said about a place like Ghana or even Australia. So since Australia is one of the highest countries which is dependent on natural GDP, what would you do if the price of gold suddenly rose? What does that mean for Australia? What does it mean for the country? All right. So this is how it is interrelated and correlated. And South Africa over here, all right, and China over here doesn't have a lot of those resources, all right, but it is heavily dependent on them. All right. So now, so now I'm just gonna scroll to the bottom, all right, again, and here. So what we're looking at, this is 0. This is what I'm looking at, this bar here, and this is showing me the percentage that is dependent on natural or on resource-based GDP. Switzerland, right here at the bottom, none of it is natural or organic GDP. Singapore, none of it is mineral based. All right. Places like Montenegro, Seychelles. All right, and these countries were appearing as some of the richest countries in terms of PPP. Seychelles, one of the richest country in Africa. So where does their GDP come from? It doesn't come from minerals. They are a country that is their GDP comes from services. All right. So does Switzerland. So does Singapore. All right. So does Maldives. This is services, hotels and stuff like that. So does Hong Kong. None of natural GDP factors. France, none. All right, 0.1% of their GDP comes from anything that they get naturally. All right, so all of these countries, you have to see how they innovate. If they don't have any natural resource, such as the Emirates, right, such as Libya, or such as Qatar, you have to figure out how do they make money and why are their people so rich. And once you do that, you are seeing how you can position yourself to make money in places like Italy, one of the biggest economies, all right? Hong Kong, one of the biggest economies. Germany, no natural wealth there, but it is one of the biggest economies, all right? And UK, none of their natural wealth, but they do have some organic GDP, 1.5%. All right. Denmark, 2.4% of their GDP comes naturally. All right. So, of course, I'm looking for America. Still scrolling up, and here we go. America, only 1.7% of their GDP is natural. 0.2% is from their own land. Okay, is from their own minerals. Okay. So, going back to this, we discovered that the gold reserves, which is a mineral, okay? And here, what we're looking at is mineral percentage of GDP. And when we look at this list, we see that Mauritania, Papua New Guinea, Papua, Papua, Papua New Guinea, Zambia. Yeah, my friend from Papua, you always used to like. I don't know if he's laughing, but the way that I say New Guinea struck a musical chord. Zambia, DRC. These are the countries that produce the most minerals. So here we're not told exactly when it's not the actual breakdown to say is it gold, is it silver, is it platinum, but it is safe to say that we're talking about minerals such as gold and silver and platinum, all right, and not oil, okay, not coal, but minerals, okay. So this mineral, let's say gold, silver, and platinum, is produced mostly by these countries, right? But in actuality, the countries that have these in reserve, that keep them, that want them, that buy them, that have them, the most is United States. But it has none of it, but it holds the value of those things. So these things are very valuable, okay? Because the US has 8,113 tons of gold. So this resource will impact the United States positively if it's going to appreciate. And it will also impact these countries positively if it appreciates. So the appreciation of gold should be seen, recorded, and evident in both New Guinea, right? Papua New Guinea, which is bordering Indonesia. It should be seen in this place, Papua New Guinea. It should be seen in Mali. It should be seen in Ghana and Australia. Even before it's seen in US, Germany, Italy, France, Russia, and China, which don't have any of this. And Switzerland is one of the lowest countries at the bottom of the list who have no natural wealth, but they have a lot of this gold. And as we can see, China is growing its gold reserves. It was 1936 tons, now it's 1948 tons. So is Russia growing these reserves. They're buying more and more and more. All right, and the U.S. is not growing their reserves as yet, but it has a lot. All right, so some countries that are growing their reserves, Turkey, all right, growing reserves, and let's look at these countries. What's happening to Russia? More gold reserves. Does it give their country's currency more credibility? I think it does. So because with gold you have real wealth, natural wealth, organic wealth that you can't dispute. If I give you gold, you're gonna take it, because it's gold. Kazakhstan's reserves are getting lower. Okay, Uzbekistan is getting higher, accumulating more gold. But all of these countries are non-producers, all right, are non-producers. And in Africa, which is the focal point, and this will be my last point as I begin to wrap this up. So in Africa, Algeria has the most gold in reserve, followed by South Africa, and then Libya. So of these countries, they are actually found on the map of gold producers, such as Ghana. Only 8 tons of gold, but in terms of its GDP and its productivity, right? So the natural resources in Ghana account for 14%, which is high. 14% of their GDP comes from gold, and comes from natural resources, and 9.6 comes from gold. All right. So for a place like Ghana, it's like we know that they do have a lot of gold, and Australia 7.2 from gold, and let's look at their reserves. I'm gonna go to the world. Australia. How much gold does Australia have? So it's not on the first page, okay? All right, not it's yeah, it's not at the very top. It's not at the very top. So these countries keep this gold because it has a lot of value. So what we're looking for in trading. So this is Austria, not Australia. What we're looking for when we're trading is the value hidden in certain things that we might not see. So the the value of this gold is very important. All right, where is it? Australia, UK, Lebanon, Spain, Austria, Poland, Algeria, Singapore, South Australia, 68 tons of gold. All right, Indonesia has a lot of gold. Egypt does. Libya does. So all of these countries need to build their gold reserves. But in any case, what is showing us is the fact that natural resources, even though they're a part, like they're a very big part of certain economies in the world, right? Economies such as Iraq, which is exporting oil. So how does oil, in the case of Iraq, affect its GDP, the oil prices and whatnot? So if oil is rising, what happens to Iraq and its currency and its people? The same thing with Congo. What is it exporting, right? And how much of that is applicable to the price fluctuations? So you can do this for most of the countries and look at how the trade in these countries, let's just say these are the top 3 oil countries, right? Kuwait is also in there, Angola oil, Oman oil, and look at how these economies have structured themselves. What sort of problems do they have, and figure out how their economies could possibly be made better. And if anything materializes, then you'll be the first one to realize the relationship and the causality that is made through international macroeconomics. This is a global trading preview, right? And we're just looking at PPP, GDP, GDP per capita. We didn't look at real GDP, which just removes inflation. What we just looked at is nominal GDP. All right. So in other cases, we can look at different economies, right? The world economy and US, Japan, Germany, right? And then look in terms of agriculture. How much of their money comes from agriculture, all right? So you could look at the country that's the biggest agricultural country, right? And you could look at it in terms of industry, and you could look at it in terms of service, and look at the different relationships that exist. And this is real gross domestic. So this shows you the money free from inflation. All right, so it calculates inflation. So all of these things are important. So this is 1.6 trillion in India, right? And 196 comes from agriculture. So in the case that soya beans gets more expensive, we are supposed to see how this in fact impacts India and its trading partners and things like that. And in the service economy, which is usually the biggest in most economies, but not all, when you look at developing economies and emerging economies, usually their biggest factor in GDP is agriculture. But the more that their non-farm payrolls are reflecting a difference in people moving from agriculture to industry or services, is the greater the economy grows, because agriculture is being more and more mechanized. So there's less and less need for more and more people farming. So having employment in the farming sector is not a good thing in terms of development on large basis in general terms. It's not always the case. There's no one size fits all. But generally speaking, you're supposed to, generally speaking, developed communities, countries have more people in the service sector than industry and agriculture. And underdeveloped countries have more people in the agricultural sector other than industry and services. So this is something you'll see as a constant pattern. So it's just one aspect, and I'm really not gonna get into all of that because I really don't want this to be too long. But you know, I'm still here. Nominal GDP sector composition. So this is what we have. I'm not gonna go over this, but let me see if there's something I can just show you, because you know this is just one video and I hope that it gives you more. So GDP sector comparison. Alright, so Angola agricultural. Alright, so let's look at GDP purchasing power in terms of sectors. This is 2017, but it's okay. So let's look at agriculture. So I think agriculture will be very important. So as you can see, a country like Singapore, 0% of their GDP comes from agriculture, but 75% is services. And all they're doing is making people make deals, all right? And this is the actual monetary value. Monaco, one of the biggest, one of the highest ranking in terms of PPP per capita. So is Macau. Okay, so when you look at, all right, let's find a more familiar face. All right, Hong Kong, Sweden. All right, most of it is services. Canada, most of it is services. All right, and Switzerland, virtually all of it is services and this. So this is just the pattern in most of these developed communities, and agriculture does not play such a huge role, although everyone needs to eat. But then when you look at other countries such as Sierra Leone, you see that 60% of their GDP triple P is agriculture. Somalia, right? Agriculture. And services low. Industry is the lowest. All right. So for them, Chad, you see, most of them are farming so that they can eat. So all of these people might be agricultural, but how many people are farming on a large scale like Russians? So Mali, Niger, see, all of these countries are not the most developed countries. Ethiopia has an interesting blend because 34% is agriculture, 43%, and Ethiopia has a huge market of coffee. They export coffee. And let's see. So you see, there are other like niche countries such as Ethiopia, you know, Malawi, Uganda. So you see, all of these have a pretty big agricultural sector. So the better the country is, the more industrialized it becomes and the more services it offers. So this is what we see when, alright, so we have Malawi. They don't really farm, even though they fish, but they have a lot of services. And let's look at the most serviced. Alright, let's look at the most industrious. So the most industrious economy is Angola. So most of their GDP comes from their industry, and what they do is oil. So they have a huge economy focused on oil. Kuwait, oil. Northern Mariana Islands. Alright, and then we have Equatorial Guinea. We have Libya, oil. We have the Republic of Congo, Iraq, one of the most services, and Qatar. interesting. One of the most in industries. And then let's look at the most services. So that we just get a full spectrum. So we have Gibraltar, which 100% of everything they do. They don't do industry. They don't do agriculture. They just do services. Macau, all right. All they do is gambling. That's the whole economy. Of course, the Virgin Islands, all they do is register your companies. And of course, people gotta eat because people live in these places, so there is some industrial activity. And a familiar face, let's see, Seychelles. And we've seen Seychelles appear in a lot, and we see that most of its money comes from services. All right, services. And the US, right? Huge service economy and a very small industrial economy. All right, so I guess we're gonna stop here and yeah, take a break, and we'll see each other very soon in another installment on this particular subject. Maybe something else, because yeah, you kind of is exhausted at this point. So I'll see you soon. Thank you a lot for spending this time with me.